Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, December 4th, 2023. Hope everyone had a wonderful weekend, as good as a weekend as I did as a lifelong Huskies fan. Looking forward to playing the Texas Longhorns in about a month here. So, big, great season of college football. Phenomenal season. But let's just get into our executive summary here for my leadoff morning note. As always, if you want the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So, number one, Bloomberg's latest MLive Pulse survey confirmed that roughly two-thirds of both professional and retail investors expect their personal investors to fare better than 2024 than they fared in 2023. That is a strong vote of confidence given that the 60/40 portfolio is up nearly 12% year to date. Alternative assets like gold and Bitcoin have appreciated more. Number two, there are other indications that the soft landing scenario is now consensus, not the least of which are market pricing of 5 rate cuts next year starting in March, somewhat rich equity valuations, and the current 91st percentile reading in the AAII Bulls Bear spread. Given that consensus, it's our job as dutiful macro risk managers to monitor for data that may cause investor consensus to ditch the soft landing scenario in favor of the hard or no landing scenarios because a rising probability of either outcome represents a key market risk. And then lastly, number three, our latest Bayesian review of domestic high frequency economic data are generally supportive of the consensus soft landing scenario. This and next week, we will receive several key data points that will go a long way towards determining whether December will provide a Santa Claus rally that extends into a positive January effect. Those are the October JOLTS and ISM services on Tuesday the 5th, the November ADP report, Q3 non-farm productivity, and Q3 employment costs, unit labor costs on Wednesday the 6th. Initial and continuing jobless claims are live every week on Thursday morning. And then the November jobs report and December University of Michigan Consumer Sentiment Survey this Friday on the 8th. Next week, we have November CPI, the November NFIB Small Business Optimism Survey, and the November Federal Budget Statement on Tuesday the 12th. We have November PPI on Wednesday the 13th. We have November retail sales on Thursday the 14th, and November industrial production on Friday the 15th. So very important couple of weeks here for asset markets. We have OPEX next Friday. So if we're going to get a correction, it probably has to happen this week, just given the positive Anna and Charm flows that we're likely to experience heading into OPEX next Friday. Or not, sorry, yeah, next Friday on the 15th. Transitioning to my 42 macro dashboard here, we have several macro market indicators that are overbought, oversold this morning. We'll start with the 2-year nominal treasury yield getting towards the lower boundary of that range there. The 10-year nominal treasury yield getting towards the lower boundary of the range, really only a couple of basis points above that, with an upside towards about 4.47. The 10-year tips yield right around the lower boundary of the range there, with upside to about 2.21%. And I want to say we had another overbought signal here in the Russell this morning. So just be aware of that. Obviously, if bond yields are oversold, you're probably given the positive correlation we've seen between stocks and bonds over the past, really over the past couple of years, but specifically over the past few weeks. It's very unlikely that we see equities not correct if bonds back up in yields on any sort of data that supports the sort of no landing scenario, which is, again, a key market risk. And then lastly, transitioning to our 42 Macro Aware community, phenomenal resource. They're having a great, wonderful time interacting with our clients and subscribers here in our community. Not only am I having a wonderful time, you guys are having a wonderful time interacting with each other. I can see that some of the more novice investors in our community, when they have questions, they're typically answered even before I have a chance to get to them by some of the more sophisticated and advanced investors in our community. And to me, that's such a wonderful blessing that we're very much grateful to be a part of in terms of building this community and watching it grow, and it will continue to grow over time. In terms of the question this morning, so we're getting a question really about a piece of research that we published. This is a statement from our qualitative research summary that we publish in every piece of our research. Transitory factors dramatically inflated the federal budget deficit throughout fiscal 2023 in ways that are unlikely to be matched in fiscal 2024. So the question is asking, can you elaborate on these transitory factors? So sounds like someone is not a subscriber of our macro scouting report, because this is something we discussed in great detail in our macro scouting report presentations over the past few months. But I'll just kind of quickly rattle them off. So there's a few things that have really, again, inflated the federal budget deficit in fiscal 2023 that are unlikely to be matched in fiscal 2024. We have individual income tax receipts are down 17% on a year-over-year, year-to-date basis through October. tax receipts are about 55, somewhere between 50 and 55% of federal receipts. So the fact that tax receipts are down about 20% on a year-over-year, year-to-date basis, and this is primarily because California was largely offline in terms of paying federal income taxes due to some of the natural disasters that they experienced in that state. Hawaii is obviously one of those states as well. That's been a very positive boost to the economy in terms of folks not having to withhold those income taxes in those states. Now that's going to change. Obviously, they're going to have to pay those taxes next April. But for now, it's been a supportive factor that is again not likely to be matched next year. In terms of the cost of living increase adjustment, we had an 8.9% cost of living increase adjustment for 2023, calendar 2023, and we're seeing things like Medicare, which is 14% of the federal expenditures up plus 19% year over year, year to date. Social Security up, which is 22% of the federal expenditures, up about 12% year over year, year to date. So that's those are two things that are obviously very much impacted by that 9% cost of living increase adjustment. That is more than likely to be somewhere in the area code of 3% here in 2023. And then lastly, net interest. In terms of the lagged impact of the aggressive policy tightening we saw throughout 2022, net interest is about 11% of federal expenditures now, up from about 5% in 2020. So more than double in terms of its share of total expenditures, and that number is growing up 42% on a year-over-year, year-to-date basis. Up 42%. Now we're not going to be up 42% next year in terms of how much incremental interest the federal budget, the Treasury is paying to private sector investors, because again, we're not going to change the policy rate with the same degree on a year-over-year basis next year. In fact, we could actually see policy rate easing in terms of federal budget, in terms of federal expenditures. So we keep that on close watch. We keep all these line items on close watch every month in our macro scouting report in terms of our fiscal policy monitor. So definitely check that out. And we'll wrap it up there. So this is Darius Dale presenting our macro minute for Monday, December 4th, 2023. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.